the idea of waiting for a stop run and then wait for the market to come back down in to the range prior to all that run up, and then wait for the bearish breaker. In this case, the bearish breaker is this candle and this candle. The most sensitivity is going to come inside of the most lowest down close candle prior to the run up, because you have a high, a low, and then you have the stop hunt, and then the reversal. Well, that's trading with a breaker. Inversion fair value gaps, if you have a gap inside of the range that creates the bearish breaker, as we have here. Now remember what I taught you. A down close candle that is a fair value gap is a CIVI. A up close candle right here, this is the opposite, which is a BISI. B-I-S-I. Buy side imbalance, sell side inefficiency. Now, this is going to be a huge step in understanding narrative and understanding directional bias and also reversal patterns. This fair value gap here, if you don't understand what you're looking for and you don't have the element of time, Dave, and you trade back down into this fair value gap, you might be lulled into thinking, well, wow, this is an opportunity for me to take one of those ICT fair value gap buys and go long. And then it's to your detriment that it reverses and collapses on you. Understanding that it's 7 o'clock, post 7 o'clock, we have relative equal highs. It rallies after, remember the new week opening gap I talked about yesterday? You're going to discover, Caleb, that your model is going to be gravitating towards those new week opening gaps. That's your model. You're going to be trading in that direction. But before we get to that, you have to be able to look at small fluctuations around segments of time that will have a repeating phenomenon, that they all look very similar to one another. It's a fractal, okay? But the fractal element is only repeating and verifiable on the time frames I'm teaching you to focus on right now. We're not going anything higher than the 15-minute time frame. But this buy side imbalance, sell side inefficiency, that fair value gap, is going to have a role reversal. That is an inversion fair value gap. So the market creates this fair value gap after this run here. You don't want to use that as a buy. We're so elongated and stretched out from London, and it's past 7 o'clock in the morning. So now we're in an AM session. AM session characteristic is always, first and foremost, characteristic is retrade back into the London range. The London range is whatever the highest high and the lowest low was between 2 o'clock in the morning and 5 o'clock in the morning, Eastern Standard Time. Now, I'm going to slow things down here because I already know some of your heads are spinning. You're like, dude, you said this is going to be easy. You're not complicated. What I just said is not complicated. You have to look at these specific times of the day. So if we're anticipating a rally up because of these relative equal highs, and it's after 7 o'clock in the morning, and it creates this type of reversal scenario where it breaks down, your eye should go right to, are we looking for relative equal highs or relative equal lows, or are we looking for inefficiencies? You have to go with what the chart's giving you. You can only trade with the premise of relative equal lows or relative equal highs if it's in price action. If it's not there, you can't refer to it. So if there's nothing else in price, because we want below these relative equal lows there, what's left now? At this price point right here, if there were not anything else on the chart yet over here, this is the only chart candlestick at the time you're watching it. Where does your eye go? Well, you'll naturally go to this. But my eye jumps to the stop hunt here and the breaker. And from the breaker to the high where the stops were taken, is there a fair value gap? If there is, I'm going to navigate away from the breaker, and I want to have that premium level right there. I want that. That's the one I want. Everybody else might be trading down here, and they might get a fill right there, and they won't be comfortable trading into this high here or right there. See where it's stopping? It's not random. The market breaks down. That Q, working off of that inversion fair value gap, that drop, and it creates this gap right there. That right there is the sweet spot when you're bearish and you have everything behind you that's in play. It's your optimal trade entry. It's your model 2022. It's right there. And then this becomes a selling point. And then what do you have at this point? You have this low and this low. And what time of day is that? 8 o'clock. So the price is rallying up against the underlying expected move or directional bias, because this move here has caused a potential reversal. So now you have relative equal lows here. But how far can it go? You have to refer to the range prior to that reversal pattern that formed after relative equal highs have been taken. So let me slow you down because you're getting a little panicked, I'm sure. This is too much information. My head's spinning, ICT. All you're doing is you're looking for areas where they can stop people out and go the other direction. That's essentially all you're doing. And you're looking for little periods of price action where obvious highs can be targeted, obvious lows can be targeted for liquidity purposes. And in between them, or if there's nothing new to work off of, then you focus on all of the fair value gaps, the inefficiencies. That means things that we've been coloring here with the rectangles. Okay? Your eye will jump to them with experience. You'll see them more the more you do this. And because of that experience factor, you'll learn to filter out some of them because they've already been used several times. It doesn't mean that they won't be used again. It just means that the ones that are unfilled or left in a state of imbalance, like this portion of this gray box here, from this candlestick's high to that candlestick's low, there's a little bit of inefficiency. And graphically, it looks like this. That's the remaining portion that's inefficient, that little segment up there. It doesn't mean it can or needs to fill it right now. It's just that's the part that my eye goes to. But you still want to have the low, the midpoint, which is consequent encroachment, and the high. You want to have those levels all the time because they will refer to them. If the price is trading anywhere around this range here the rest of the day, watch and see how it uses it. It will use it again. So if you want to talk about support and resistance, these inefficiencies are the real support and resistance in price action. So if we have an inversion fair value gap here after these relative equal highs have been traded through and it starts to break down, no panic. Don't worry about panicking. There's no reason to do that. Go into this price run here. That's your breaker where it runs up and tags all the stops, gets people stopped out. If they were short, they're not allowed to be profitable. Or trick them into a long trade, and then when they start raking them across the coals going lower, they're unprofitable. If that's the case, your eye goes into this price run. Is there a fair value gap there? If there is, extend it forward and then wait for it to trade up there. Don't sell yourself short and only look for the return to the breaker or the low point, because it's going to trade right back up into that. And if you go back, notice that this is the only buy side and sell side inefficiency. And once you have a valid return here and it sells off, what you should be focusing on is all of the SIBIs. All of the SIBIs until the narrative is likely to change bullish. Your focus goes to only looking for sell side imbalances. That means a down close candle that has a segment with the previous candle's low and the subsequent candle after it has a high that doesn't connect. And the only bridge between those 2 points is the down close candle in between. That's your fair value gap. And it's specifically a sell side imbalance, buy side inefficiency. And by having that, what that does, it removes the ambiguity. And it gives you a very specific process of saying, okay, I'm only focusing on these specific fair value gaps. I get that. The very first fair value gap prior to a stop run, always, always, always have that one noted. And that's why it's colored red here, or pink if you want to call it that. Because this is a change in a direction. And what this is doing is acting just like an order block. It's just change in the state of delivery. Oh. So I'm incorporating narrative where the market goes up after 7 o'clock, stop hunt, change, breaks lower, comes right back up into inefficiency, but to a very specific fair value gap. It's the first one prior to a stop hunt. This fair value gap, okay, if it's not there, then you use the breaker. It's very simple. It's the last down close candle, okay? But your stop needs to be above the highest high of the consecutive down close candles, because this is all the bearish breaker, both of these candles here. So your stop has to be above that, okay? How much? Oh, two ticks, maybe 1 tick. Many times I've used this to high, because if it's really good, it really won't like to go back up into the full range of that. So using the very high of that, in my case, it would be fine. Not if you have this gap here inside the leg that has a stop hunt, because if you have that, then you could potentially see a whole return back up into this, and maybe a little mohawk, a little tiny little spike above outside with the wick of the candle, but the body be inside or below that gap. So that's all part of stop management. So I talked that in there with no extra charge. But that changes the state of delivery, meaning that we went up to stop out, and then this is where everything algorithmically changes. Now we're going to start going lower. It's going to seek sell side liquidity. It's going to reach for sell side. It's going to expand lower. So you want to key off of and look for turning points, or what will be future entry points for you, Caleb, for trades that key off of these sell side imbalances, buy side inefficiencies. Every single CIBI, every single short-term high. So why do you want a short-term high noted? Even if it's a singular one, because there's stops above that. Okay, we already have a relative equal high here that formed, and it caused a potential reversal that moves lower, that seeks liquidity. We had relative equal lows here, it traded down through that, and then we had all this business in here. Every sell side imbalance, every sell side imbalance. Don't see anyone in here. Yeah. Notice how this one here. What is this one? What's this fair value gap? By classification and name, what would you call that one? So buy side imbalance, sell side inefficiency. Okay. I'm not looking at that one. I won't highlight that one. I won't extend it forward because it's against the underlying direction and the state of delivery, which is it wants to go lower. So if it wants to go lower, I'm not interested in this unless it shows me that it wants to reverse and it's done something very violent down here. Like it could do it here. I'm not saying it will, but if it did something violent and started to reverse, then I would draw my attention to this one, because then I could act on that as an inversion fair value gap. At 8 o'clock is the same thing. There's another point of confusion I want to clarify. I talked about the first 30 minutes after 7 o'clock and after 8 o'clock and after 9 o'clock. That is your pre-session range. Okay, it is 30 minutes of you expecting something opposite. So in other words, if you see relative equal highs, what would you expect after 8 o'clock? You would expect a low, or a price run lower. What is that by definition? Opposing directional run that's against where you think it's directly going to go. That's a Judas swing. That's manipulation. It's something that goes against the grain of what you're expecting. Not what everybody else on the internet's doing, but what you're expecting. Okay. In this case, we have a descent. Even though they were not trying to trade relative equal highs and lows prior to 7 o'clock in the morning, if this does this and it starts to move lower, you have to incorporate the range. What range is that? The low that was formed prior to it crossing the threshold of 7 o'clock in the morning. So we have all of this run here. So every single one of these inefficiencies over here, 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 even though it's been used already, you extend them in time. And they will be places for you to anticipate price going up to and pushing into it, and then resisting and going lower as it works and gravitates to that low right there, as I was hinting at earlier. But the range, okay, the pre-session or pre-market range after the top of the hour, whether it be 7 o'clock, 8 o'clock, or 9 o'clock. These are your 3 windows of opportunity. So right away, we can study and see, okay, there was really nothing in here except for these 2 right here, these little small little ones. So what did it do? It rallied up. Where'd it go to? Some random level. Nobody could have known that it was going to go to that level, but now you do. You have a stop hunt. The market broke down. So this is a shift in market structure, okay? And this is a optimal trade entry. Even if you didn't have all the stuff I'm teaching you here and amplifying it, you already know this. This was the flagship pattern of my channel since 2012. The optimal trade entry. A shift in market structure. Measure your high to your low, 60 to 72% retracement, 62 to 72% retracement level, and 70.5 level. Each hour at 7 o'clock, in this case 8 o'clock, and at 9 o'clock, what you're doing is you're starting the whole process all over again. You're waiting for relative equal highs to form or identifying relative equal lows. At 8 o'clock, you can look prior to 8 o'clock. You just can't look prior to 7 o'clock for relative equal highs or lows. because you're trying to work inside the range of the morning session. Okay, the morning session is essentially 7 o'clock to 11 o'clock in the morning. Technically until noon, but 11 o'clock for me. You anticipate that, oh, it's a matter of just going up. Once it gets into here, all you got to do is sell short right there. That's not it, folks. You have to anticipate a measure of manipulation. What was the price doing here? I told you it was getting kind of sloppy. We have this inefficiency, yeah, but what else is there? What else is there? You have this energetic drop that created that SIBI, and there's going to be what trailed there. For anyone that's short, they're going to put their stop loss right there. Well, that efficiently been removed with this bump here. Back into an old SIBI, and then you have a market breakdown. Look at the work around the halfway point, which is consequent encroachment. The market drops, opens again here, breaks lower. We have an inefficiency. The bodies are telling you, yes, this is going to go lower. Why? Because it stops right there. See that? The wicks are allowed to do what? A little bit of damage. Is it going to random locations? No, it just bumps the bottom of that SIBI over there. But in short, what you're doing is at 7 o'clock, that starts the hunt for relative equal highs or lows. If you see a disruption, like we were talking about yesterday, where it's jagged, you see how it's nice and jagged? That's indicating it's probably going to go the opposite direction, especially if you have all these other supporting factors where that would have been a breaker. This is obviously a high probability inversion fair value gap, and it hits it here, respects consequent encroachment, breaks down, and then we have another return in here. Here's an optimal trend entry as well. And everything is, your mindset is, okay, I'm looking for lower, I'm looking for lower, I'm looking for lower, and it breaks lower. And then you highlight every single time it creates an inefficiency where it's a big candle that doesn't have any overlapping with the candle prior to it forming or the candle after it. So it creates that inefficiency, that imbalance. And then when you have these long protracted consolidations like that, it's really better for you to sit still. Let them do whatever they're going to do. Why? What do we have there? What did I say yesterday? We have relative equal highs and we have relative equal lows. You're going to be playing the breakout game. And I'm not a breakout artist. I'm not trying to guess. I want to see what the market's going to do. So by this run up, it can trade into any one of these fair value gaps in here. It does. And does it fall out of bed? Yep. So what I would require, and you've heard me say, well, not technically you heard me, you'll see in old tweets where I'll say, we want to see this fair value gap act as an inversion fair value gap. Well, that means it ran above it, and it's got to go below it and then do this right there, that function of redelivering to it. Then a deeper protraction lower to upset any liquidity that would be resting below here, as much as, and to the degree of reaching down into that low over there, because that's the low in London. So all your charts are going to have about 6 o'clock or so, just to get a little taste of what London was doing. And then everything else in your charts needs to be very, very simple, but I want 9 o'clock delineated, 8 o'clock delineated, and 7 o'clock delineated. And any formation of relative equal highs or lows, I want you to annotate them. The relative equal lows and the relative equal highs. I said yesterday, when you have both of them, you wait. You wait for them to take one side out. What does it do? It runs higher. So what's it going to attack now? That one. And it runs down below it. Okay? So as it is right now, if there was any trade taken or no trade taken at all, you would do nothing, because it's already done a whole lot of movement, and it's back in an area where I wouldn't want to see it as a trade back in this SIBI again, because we've already done once, twice overlapped it, respected it, and now we're back inside of it again. That is low probability, and it could fall out of bed and crash 1,000 points a day. It still wouldn't be a trade I took, because it's against the rules of me wanting to use it. It's been overlapped and worked multiple times, and it's done enough. So you have to have an expectation on price at a time of day. In this case, you have 3 specific times of the day. And the first 30 minutes after 7 o'clock, after 8 o'clock, and after 9 o'clock, if there is relative equal highs or relative equal lows below the marketplace, then you want to see a move the first 30 minutes go in the opposite direction up. If there's relative equal highs that form after 7 o'clock, after 8 o'clock, and after 9 o'clock, that first 30 minutes, You want to see the market drop. You want to see a measure of manipulation. It doesn't have to only be in that first 30 minutes. But in my mind, I'm thinking, I want to see that. And if I got that and it was given to me in delivery price, then my interest in this move is even more peaked. I'm really interested in it. If it doesn't do it, I'll wait for more information because it might have a deeper retracement than I would have expected initially. And then I'll wait for a breakdown. And then having all these inefficiencies extended over, the market will refer back to them. And then all I have to do is wait for a bust to get there and then ride that thing down to Southern Town. And that's it, and be content with it. Okay. So if the market's going to gravitate lower, your eye jumps to only SIBIs. If you start seeing these SIBIs, that's these down close, big, large range candles, you have one here. You see that?